Hey guys, it's Zach from Us versus Herd, coming back today with another video. Today I want to talk about earnings, since the earnings season is coming up very shortly here, or if not, has been kicked off today with a few like Netflix and United Airlines. So I want to talk about some of the effects and what to look for in earnings. So I want to look back at a trade that I did before on Alta. So as you can see, this is where the earnings came out. It dropped straight down. But if you don't know, they actually beat. So if you look into here, they actually beat their earnings by quite a bit, actually. So 1.6 billion was their revenue, and per share was estimate of 213. So that's the revenue was grew 24.6% on the year over basis. So that's pretty substantial. So when that news came out, look how interesting this is. This went straight down after beating earnings. I know they missed on guidance, but it was just a fraction of a miss, I'm pretty sure. I just wanted to show one graph. See, when you do an earnings play and you're right, sometimes it doesn't even go the way that you would expect it to. So for example, on Alta, I took the right position. I took a long position. I sold some puts and it went straight down. Luckily, by tomorrow morning, it had gapped up and then went straight up, and I was able to make max profit. So that's one example of some crazy stuff. So I also want to look at Lulu here and show you guys what happened. I think you guys already know what happened, but in case you don't, I only find the spot where the earnings came out for them. Let's take a look. All right, there's earnings right there. They dropped from 66.28 all the way down to 55.77. That's a massive hit. I mean, that's a large, you're talking large percentage of the stock here, more than 10% just vanished just like that. It leveled out and went lower for a while and consolidated, and it came back up somewhat eventually, but it's not anywhere near it used to be. It's nowhere near that 66 mark. So when you're going to do earnings, it's good to know the risk reward factor of the whole thing. You have a high potential to make money quickly. You also have a high potential to lose money quickly. So what should you do? Should you sell premium or buy premium or what? Typically, you should only buy premium if you get a good deal, like 5 cents or 10 cents per contract. But for the most part, selling premium is fine. Or the preferred for us. You have to get a good range. So we try to make it, if we're bearish or bullish, we take a position. As for Lulu, we didn't end up trading it, I don't believe. And if we did, I don't remember the exact trade, but I don't think we made money, obviously, because it went down real low. I did do Netflix today, so let's take a look at Netflix real quick. All right, doesn't seem like Netflix wants to load, so that's okay. But basically on Netflix, I'll show you the earnings were on here, on Earnings Whisperer. All right, so for earnings here, which came out after close today, they were in line. So they beat, they actually did beat. So if you look at it, it was 40 cents per share, revenue grew 34.7%. So that's pretty interesting if you look at it that way. Netflix did go, they did beat earnings. Their chart, however, they did go straight down. They went $10 down and then they came back up. But they're fine now. So it's pretty interesting to see what happens when you do make a play. So we took a bullish position on Netflix. So is it worth it? Well, the spread we had was the 144 and 142 puts on Netflix, and that was, we risked $80 for $115 of our money. So the max we could lose was 115. The max we could make was 80 some dollars. If you find a trade like that, then yes, it is worth it, because you're basically going a 1-for-1. Anytime you have to put down more money at risk, since you don't really know what's going to happen, you can only speculate. since it's better to put down less money or the same amount of money that you would receive. So it's a 1-for-1 roughly. I know 80 isn't exactly 100, but it's pretty close, and it'll help you out when you're factoring in the risk reward. So if you put down $100 and you get back 80, if you do max profit, then that's worth it. But if you do, let's say the max you can make is $80 and you put down 400, so that's the max you could lose, and you have a bigger problem, because if it doesn't go the way you thought it would, then you're going to lose $400, and the amount you could have only made would have been $80. So that risk is unnecessary. You don't have to take that. You can take a more bullish position that's near the money in order to get the 1-for-1. So those are some of just the positions that we took on some things. Like on Alta, we took a bullish position on Alta, and it beat last time, and it went down and went back up. And then, so the most part, we mostly sell premium on these, but we make sure that it's a 1-for-1 at least, if we're not convinced on it. But if it's like Amazon or something that we know is going to go up, something that we're extremely bullish on, and we know that it always has good earnings and that it goes up, we usually buy a larger position that's riskier, that gives us more of an upside though. So like maybe we put down 400, but we can also make 200. So something like that would be an acceptable trade if you're familiar with the company and where it's headed. So overall, if you make an earnings play, make sure that you're properly assessing the risk. Otherwise, you could end your whole account right there. I mean, if you put down like a regular vertical, like you would on anything else on a regular day, and you didn't know his earnings, or you did know and you were just being bullish or bearish, and it went the opposite direction on you, you lose the entire account. That's it, game over. It's not worth the risk. It's not worth the gamble. So if you do make an earnings play, make sure that you do factor in the proper risk reward. Make sure you know that you're putting in a certain amount, and the most you could lose isn't so detrimental to your accounts. Also, a thing to factor in is when you do actually buy the position, you should wait until so if earnings is one day out, you should wait till the day of the earnings. So like, for example, Netflix today was reporting after close. So I bought the position at 2:45, 15 minutes before close. If you bought it a day before, you're going to have a tougher time, because the price of the option is going to be different. Maybe less, maybe more, but most likely less. Especially if you're buying something that's near the money. So you should wait until as late as you can to buy the position, unless like a stock is going up majorly and you're buying a bullish position, then you might as well just get in. But for the most part, you should wait as long as you can, as close you can to the earnings, because Netflix was after close today. So I waited, and so now it seems to be leveling off, but Netflix will, since it didn't do exceptionally well, we'll probably just end up collecting premium on it, or on the theta. So instead of making money by it going up, we'll probably just take the theta, because it didn't really move. It pretty much leveled out at where it needed to be after this news here. So that means everyone else who bought calls and sold puts, and it didn't go either way, extremely direction, they're going to lose their money, and we're going to take it. And that's why we sell premium on these, unless you get a really, really good deal, like you get something that's pretty close to, that's a pretty realistic expectation, that's pretty close to the money, and it's 5 cents or 10 cents, and you buy 1 or 2 just to see what would happen. I could see that being okay, but if you buy like 200 of them, or not 200, but like 20 of them or something, and you end up spending $200, then it's just gambling at that point. It's not worth it. It's not even, it's risky. You could lose a lot, and your probability for making it is not very high. So that's why we sell premium, because if it doesn't move, you will make the max. If it doesn't move, you will make the theta. You'll get the theta. We'll collect the premium off that. If it does move up in the direction that you want it to, or down the position that you took, then you'll make money faster. However, If it goes against you, you lose altogether. So you have to make sure that you're putting your max loss at a defined risk. If your max loss is not defined, then you shouldn't be trading it, especially if it's earnings. Just period. It should definitely be defined, and you should never ever do an undefined risk play on earnings. Even if you're convinced, because the stock doesn't always do what you want it to. As you saw earlier on Alta, even if you're right, it could go straight down. So there's some things you have to factor in. So if you guys like the video, like, comment, and subscribe. We're gonna make videos daily for you. We're gonna keep going at it, and just remember that it's always us versus herd. So join us.